Good afternoon and welcome back. Let's move on and look at exercise 2-11. Similar to the previous exercise we worked on, in this exercise, we have a list of transactions that we need to record in the general journal. Again, they've given us a list of account names, and I have those written down over here, and it's under the chart of accounts, obviously. Chart of account, again, just simply means it's a list of the accounts that are used or may be used. Further, I'm going to bring this up over here so we can use this if we need any guidance. So this is a new company, and they have told us that the first transaction they've engaged in is they've issued common stock for $21,000. So in this transaction, what has happened is the business received cash, $21,000. Cash is an asset, so cash will be debited. And in exchange for that, they gave the owners $21,000 in common stock. So common stock increases, which means retained earnings increases. So in my journal entry, I will have cash debit and common stock credit, and the dollar amount is $21,000. So cash debit, common stock credit, my accounting equation is in balance. Both sides have gone up by $21,000. The next transaction, I'm told that I obtained $9,000. The word obtained simply means I got $9,000 from the bank by signing a note. When the bank gives me money, they obviously expect that I'm going to return the money with interest. So for now, when they say I signed a note, it means I have agreed to repay. I've agreed I have a liability to repay, and that's a note payable. You can see the account name over here, note payable. I received cash. My cash balance went up, but my liability also went up. So cash debit and notes payable credit, and the dollar amount is $9,000. If you look at the first two transactions, in both these transactions, I received cash. Both of these are financing activities. So if you're thinking of your statement of cash flow, these are financing activities. This came from the owners. I don't need to return the money. Eventually, I'll have to turn a profit and give them dividends, but I don't need to return this money. The money I borrowed from the bank, I'm obligated to return it. There are terms and conditions. I'll have to return the money. Both of these are financing activities. Let's move on to the third transaction. I purchased construction equipment for $25,000 cash. So in the first two transactions, I received cash. Now I'm spending some of that money. I'm the company and I spent that money. What did I spend it on? I purchased construction equipment. So for the business, cash is an asset. It decreased, so I'll have to credit that. But I also got another asset in exchange. Construction equipment is an asset, and that will increase. This equipment, the asset will increase. So here we have an asset equipment that's going to increase, and the other asset cash is going to decrease. Both $25,000. So the accounting equation, if you look at the total numbers, it stayed the same. Both changes happen on this side. I have less cash, but I now have a new asset equipment. So my total assets are still the same as I had after the second transaction. Moving on to the third transaction, I purchased advertising for the current month for $1,100. I started my business. I got all this financing. I bought the construction equipment. I need to advertise my business. I need someone to let everyone know that I'm here for business. So I paid $1,100 to an advertising company. I'm the company. I paid cash. I parted with cash, which means cash decreased. So I'm going to credit cash, $1,000. Why did I pay this? Well, for the benefit, I got a service. The service I got was the advertisement. That service I got is an expense, and I will call it advertising expense. Advertising expense debit, cash credit. Expenses, when they increase, what happens to the retained earnings? It decreases. If you're debiting this account and under this one, you see that it's decreasing. Retained earnings has decreased because I incurred an expense. But It's a cost of doing business. I have to do that. Now let's move on to the next transaction. On the 22nd, I provided construction services for $18,000 on account. I provided services. I did my job. A customer had retained me. I did the work. I've given them a bill. I sent them an invoice for $18,000, but they have not yet paid me. I know that because it says on account. So right now I didn't get cash. Will the customer pay me? I certainly hope so. So when I issue them the bill, I will debit an account called accounts receivable. Receivable means I will get. Here, see the word payable means I was going to give in the future. Here I will get in the future. Both we're talking about cash. I will get cash. Accounts receivable is always I will receive cash from my customer because I have done the work. I have earned the revenue. When I provide goods or services, whatever is my main line of business, we call it revenues. So again, over here, if you look, we have the word service revenue, and that's the account that's going to get credited. Accounts receivable debit, service revenue credit. My accounting equation is in balance. The assets increase because accounts receivable, I had zero balance prior to this, it's gone up. And on this side, revenues increase, which means retained earnings increase, which means owner's equity increase. Now let's move on to the next transaction. In this transaction, I'm going to put this in a different color so we can focus on this for a second. It's tied to this previous transaction, the one we just completed. On the 27th, that's 5 days later, I received $13,000 cash on account from the March 22nd service. So on the 22nd, I'm receiving cash. So the easy part is cash debit. I know cash has to be debited. We're good with that. Now the question is, why did I get cash? Well, who did I get it from? I got it from my customer. Why did the customer pay me? Have I provided any new service? The answer is no. They're telling us it's on account from March 22nd. So this transaction, when I provided service, they said they would pay me later. They're paying me now. So what I need to do is I need to decrease that asset by 13,000. So I will credit it 13,000. So let's look at just this account, accounts receivable. We had 18,000 debit. After I do this journal entry, I'm left with 5,000 debit in that account, which means that customer owes me only $5,000. If I made a mistake and credited service revenue again, I'll be counting revenue a second time. I'll be overstating my revenue, and the accounts receivable will still be at 18,000. So that's also overstated. Can you imagine if you are the customer and I send you a bill again for 18,000 and say, hey, you haven't paid me 18? You're going to say, I paid 13. So accounts receivable debit here, accounts receivable is credited in this journal entry, not service revenue. So I received money for the money that was owed to me from the March 22nd the services that I provided. And finally, I paid $6,000 cash to my employees for the work that they had done. So March 28th, I'm paying cash. So this one is easy. Cash has to be credited 6,000. I paid cash because I received a benefit. The benefit I received, you can look over here, is salaries expense. And that's the account I'm going to debit. Salaries expense debit. So an expense is debited, which means my retained earnings goes down, which means my owner's equity goes down. Cash decreased, owner's equity decreased. The accounting equation is in balance. Both sides have decreased by 6,000 because I made payment for the services of my employees. So this finishes up exercise 2-11, and soon we'll start with the next exercise.